this is the case study, right? So cash out refinance after 5 years. Here's the Cleveland turnkey rental property. Talk me through this, JC.
Absolutely. So in a cash out refinance, we're getting a new loan to replace the previous loan that we have. And this beautiful thing about this asset class that banks love lending on single family rental properties. They've been doing it for decades. So it's not hard to do this. You just go to the bank and you say, hey, listen, bank, my home's appreciating. I've owned it for 5 years. The value of the home was this, now it's this. And in Cleveland, the way that we estimated what the value would be is we looked and we said, over the last 40 plus years, what's the average appreciation rate for Cleveland? Because markets are cyclical. Markets are cyclical. And there's a good chance that it's going to be somewhere close on average for that home price appreciation 5 years from now, what it was on average for the last 40 years. So in the Cleveland market, as you can see here, the estimated home price appreciation rate is 3.5% per year. So you started with a purchase price of, call it $135,000. That goes up 3.5% per year for 5 years. And the estimated market value in 2030 is now $160,000. There's a win there, okay? Now, what we do is we say, all right, we got to financially engineer this thing. This is the way that I would do it if I was that Cleveland turnkey rental property provider, which I am not, but this is the right way to financially engineer this thing. We'd say, okay, well, at that point in time, we've built up significant equity. Not only have we built up the equity from the home price appreciation, what else has happened during those 5 years, Pablo?
You have also got cash flow in your pocket.
We've got cash flow, but think about what's going on with the resident.
Debt pay down?
Yeah. So for 5 years, we have now a lower loan balance. This is where all 5 of these profit centers come together to deliver cash flow, which we're going to talk about in just a second. So you've got home prices going up in Cleveland, 3.5% a year. Every month, as you've owned this property, your resident is actually paying your loan balance down for you. And so now that loan balance is about $81,000. So we understand what the refinance costs are. I estimated them to be about $2,500. We take this new loan amount out at we take the new loan amount out at 75% of the loan to value. Now we take that amount, we subtract the refinance cost, we subtract our original loan, and that remaining amount is about $37,000 that we could unlock, put into our pockets, tax-free, for us to make another good investment decision, for us to replenish our cash reserves, to make sure that we have peace of mind in this investment, to do whatever you wanted to do. So $37,000 with a little bit of financial engineering and doing a cash out refinance is what you could estimate that you could pull out from your Cleveland turnkey property.
Okay. So $37K, if you're maximizing over 5 years, you're looking at this refinance option, that's $37K total. And then in Jacksonville, talk us through this, $48K.
Yeah. So same type of financial engineering, although we're working with different numbers here. So our purchase price started out at $226,000 for this Jacksonville property. But this is really where the difference between home price appreciation rates starts to take shape. After 5 years, you see significantly more home price appreciation in the Jacksonville market than you do in a slow or a no-growth market like Cleveland. And so this is where 3.5% of an asset, $150,000 asset versus 4.8% of appreciation of a $226,000 asset really starts to equate to tens of thousands of dollars.
Yeah.
It's like I could talk about this all the time. Like Cleveland's appreciation rate's 3.5%, Jacksonville's 4.8% per year. But that doesn't really land with anybody. Because it's hard for us to think about, I'm talking about this 3.5 or 4.8 on an asset that
on a big number.
It's a big number, right?
Yeah.
So this helps us to see the difference and why it's so important to invest in a growth market. So with all that being said, well, let's go back to that last one there. Just I want to walk through it just a little bit here. So like the market value now in 2030 for your Jacksonville property has jumped all the way up to about $286,000. So we gained about $60,000 of equity, right? We had to put a little bit more in to get it, not a whole bunch more, a little bit more in to get it, but we're gaining $60,000 of equity over a 5-year time frame, right? Now we're going to talk about how do we convert that $60,000 of equity into cash into our pocket or cash into our pocket to make another good investment. And the way that we do that is, of course, the cash out refinance. Although here I chose 65% loan to value. The reason I did this, again, I'm trying to make Cleveland look as good as possible here. And the way to make Cleveland look as good as possible for a 5-year cash flow perspective is, listen, we already know it has positive cash flow day one, a ton of it. So we want to pull out as much capital as we can in that 5-year window to put it back into your pocket. So in Cleveland, because it has so much cash flow, you can pull it out up to 75% of the value and still have it be cash flow positive.
Nice.
In Jacksonville, I chose 65% because if I was to go to 75%, it would be cash flow negative. Not going to do that. So this is actually one way where we are really trying to make Cleveland look as good as possible. In Jacksonville, there's literally money left. There's additional equity in this property that I just didn't pull out, even though I could have done that. I could have,
up the cash flow,
up the cash flow out of this, but I didn't. So even with this super conservative way of going about it, we're able to pull out $48,000. Again, we have converted home price appreciation here into cash flow into our bank account, and this is not creative. This is not doing something unorthodox. Any bank down the street will do this for you. But this is real, and this is the value of a growth market, again, helping you accomplish your cash flow goals.
Yeah, again, not creative, not just not creative, but like being extra conservative on the Jacksonville asset by making it only 65% versus 75%, extra conservative on like the numbers that you're using already to begin with because you're using performance-based numbers for JWB versus, table numbers for Jacksonville, and you don't know how that's performing based on the property manager like having their own data, right?
Oh yeah.
So then Cleveland, we are at actual month-to-month cash flow that you're pocketing year 1 through 5. It's $11,699. Refinancing cash flow at year 5, $36,698. Total cash flow in 5 years for you to do whatever you want, tax-free, $48,397. Versus Jacksonville, which has a lower month-to-month cash flow of $2,492, refinancing cash flow of $47,568. Again, like higher appreciation comes into play there, and a total cash flow of $50,060. Pretty good numbers to show, man.
Yeah, I hope this is kind of like an aha moment for a lot of us here, because a lot of us say, oh, well, I'll go to Cleveland, or I'll go to Memphis, or I'll go to Kansas City, or I'll go to these Indianapolis, these slow or no growth markets. And the only reason you're doing that is because you want more cash flow.
Yeah.
But if you're buying and holding, you should be holding on for at least 5 years. So if you look over that 5-year window, you're really not getting more positive cash flow.
Yeah.
Especially if you work with somebody who understands how to financially engineer this thing, which is why you work with JWB.
Got it. So at the end of the day, if you're doing it right, you have a professional team that is financial engineers, is giving you the best options out there. Your best option, cash flow wise, in 5 years is Jacksonville over Cleveland. And that's just over 5 years, right? Like that is just under the idea of like, we have a 5-year window for cash flow. I'm 60. At 65, I want to have the most cash in my pocket. And that's what I'm doing. If you start to expand the time horizon, right? Like this idea of betting on a growth market with a bunch of tailwinds, right? Like it's in like the southeast kind of like quadrant where the weather is good and people are moving to. It's got low cost of living. It's got highest median growing wage rate in Florida. It's the #1 corporate relocation site, growing market versus shrinking market that, like people seem to be moving away from. It just kind of, you're like extending more risk the more time you're doing it, and you're leaving more money on the table. Is that right?
Absolutely.